right, today we're going to talk about the differences between mutual funds and ETFs. So they're both very similar, so let's start with the similarities between the two investment vehicles. So first and foremost, they're both pooled investment vehicles that seek to get a broad or diversified mix of assets. And those assets can be anything from stocks to bonds, commodities, and more. And those pooled investments can be very broad, from something as broad as all of global equities to something a lot more narrow like Chinese tech stocks, and then anything in between. So those are with that groundwork, those are the primary similarities between the two vehicles. Let's start to talk about some of the distinctions between the two. So mutual funds are the much older vehicle between the two. ETFs have been a newer innovation coming out in the 1990s. So originally, mutual funds tended to be exclusively actively managed vehicles versus ETFs that were usually passively managed vehicles that track some sort of index or benchmark. The lines between those two have become increasingly blurred lately, however, with a lot more actively managed ETFs coming out, as well as passively managed mutual funds. For more information on that, we have a separate video explaining the differences between active and passive, but we'll leave it at that for this video. So since the underlying investments within the vehicle is pretty similar, and like we said, those lines are starting to get blurred between active and passive within them, really the differences boil down to structural differences between the two products. So first and foremost, we have differences in trading. Mutual funds only trade once a day at what's known as the closing NAV price. And so essentially the mutual fund takes the value of all the underlying securities and cash within the pooled investment and divides that by the number of shares to come up with an NAV price per share. Now contrast that with ETFs. Those trade intraday like a stock. And also, more often than not, where with the mutual fund, you're transacting with the actual mutual fund company. With an ETF, more often than not, you're transacting with another investor on the side of that. So I'm selling 100 shares, someone else is on the other side buying those 100 shares like a stock. The next component here is cost. So because of those operational distinctions where I'm transacting with the mutual fund company, they have to handle all the inflows and outflows of cash, the striking of the NAV, et cetera, and that can also lead to more trading costs within the underlying vehicle. That versus an ETF, where again, you're trading with more often than not another investor on the other side, leads to lower operational expenses, kind of all things being equal in an ETF versus a mutual fund. And then the last piece is taxation or tax efficiency. So ETFs tend to be a much more tax efficient vehicle as well. So again, going back to the previous example there, because you're transacting with the mutual fund company, if, for example, they receive a lot of redemptions or requests to withdraw funds from that mutual fund, if they don't have enough cash on hand, they may need to sell securities to do that. And the selling of those securities could trigger a taxable event that then gets passed on to the individual investors within the product. So you could have a situation in which the mutual fund sold an appreciated security that was purchased well before you were an investor, and that capital gains distribution gets pushed on to you. So you get a taxable event with really out the gains or the benefits of that. Versus an ETF, because more often than not, you're trading with an investor on the other side. They're not needing to sell securities within there. So typically speaking, you don't see either as large or any capital gains distributions within an ETF. So that is the primary reason why it tends to be a little bit more tax efficient vehicle. All right, so with all those advantages, let's talk about a few of the shortfalls of ETFs. So first and foremost, behavioral. Because of that intraday trading ability, investors take advantage of that and often do trade it intraday. A lot of studies show that the average holding period for a mutual fund versus an ETF, the mutual fund is much, much higher as a result of that single day trading. So the behavioral aspect of sticking with your investments for a longer period of time tend to be a little bit more conducive to a mutual fund potentially than an ETF. The next component is, while again, those lines are becoming blurred, there are more and more actively managed ETFs. That's still a smaller segment. It's still mostly passive investments. So if you are trying to seek discretionary or actively managed exposure to a specific asset class or region or what have you, more often than not, there's more options within the mutual fund universe. And then the last piece is, so ETFs, like mutual funds, do have a net asset value, but you're not trading at that net asset value. So you can see a disconnect sometimes between the market price of the security that you're going to transact in and the underlying value of those assets. Now, there is built-in incentives for the companies that are involved in the creating and redeeming of ETF shares to narrow that gap. There's an arbitrage or profit opportunity for them to make sure that that discrepancy doesn't exist. But particularly during times of market volatility or dislocations in the market, there are periods where those do diverge from each other, and you could run into a situation where you're buying the security for much more than the value of the underlying net assets, or selling it for much less than the value of the net underlying assets. So that's something to be cognizant of when trading ETFs. And with that, I think that pretty much covers the higher level overview of the distinction between mutual funds and ETFs.